Module 4 is on working capital management. Now, working capital management is actually using the information we've been discussing in earlier modules. In modules 2 and 3 in particular, we spent a bit of time on inventory, debtors, accruals, prepayments. We were discussing current assets and current liabilities. And working capital management in module 4 tries to put all that information together to give you an idea of your cash flow situation and how you're managing your working capital. To do this, we have a number of ratios. Now, ratios are comparing some information within the financial statements to help us try and understand those financial statements a bit better. And the first ratio we're going to be talking about is days debtors. Now, I should mention in this context, the information I'm using here to explain the ratio refers back to those financial statements that you may have printed out separately at the beginning of the course. The days debtors ratio is simply debtors over sales. Now, debtors, or accounts receivable, is the asset we've been discussing, which is a current asset on the balance sheet. Sales is the sales revenue contained within the income statement. If you take the debtors divided by sales and multiply by 365, you get a number of days. And the number of days is an indication or an average number of days between you selling your goods or services and you collecting the cash from your customers. How long does it take on average between selling a good or service and then collecting the cash? Now, I think it's almost obvious to say that you'd like this number to be as short as possible, because as we said earlier, you want to get that cash in your pocket as quickly as you can. So we're trying to measure how long it's taking, and we can do this measurement over time and compare it to previous years. We can compare it to a budget. We can compare it to your competitors and see what they're doing, but we're trying to work out how long it's taking. Now, at the bottom of that slide, I've done a little example using the Shobin financial statements, and those figures, the debtors, the sales, come from those financial statements, the debtors from the balance sheet, the sales from the income statement. And when we put those figures in the ratio, you can see that the answer is 48 days, which means this company takes on average 48 days to collect their cash. Now, the question you have to ask yourself is, firstly, do you understand this ratio and know this ratio for a business? And secondly, are you happy with the result? Is there anything in that result which makes you need to maybe try harder or do better at collecting these cash? Clearly, if that number becomes greater, then that means you're collecting your cash slower, and therefore you have greater risk of either having more doubtful debts, you won't collect the cash, or by the time the cash comes in, it'll be worth less than what it would have been, given the fact that money is going to lose value over time. The other one is inventory. The next ratio, days inventory. Now, the days inventory ratio again takes a figure from the balance sheet, inventory, and a figure from the income statement, but in this case not sales but cost of goods sold or cost of sales. So the debtors, the inventory is the asset, the cost of goods sold, the cost of goods sales is the expense, and taking one divided by the other times 365, this one gives you again a number of days, and this is the number of days that you actually have the inventory in your possession. How long does it take between obtaining your inventory and selling your inventory? Now again, just like with days debtors, you'd normally like this to be as short as possible. The longer you have inventory sitting around in your possession, the more likely it gets damaged, it becomes out of date, and the longer it takes to turn it into cash, because once it's in your warehouse, it can't be turned into cash until it's sold. Now, for this company, again, we've used Shobin, and we've got an answer of 87 days. So this company is taking, on average, 87 days between buying or obtaining their inventory, or making their inventory, and selling it. And again, you have to ask yourself your question in your business, do you know what your ratio is, and are you happy with that length of time? Now, clearly the most appropriate ratio for all of these ratios, but the most appropriate number, particularly for the days inventory, is going to very much depend upon the nature of the business. 87 days, for example, might be fine for a person who sells used cars, or it might be still a little bit long, but not too bad for a person who sells used cars. But if you were selling bread or milk, then clearly 87 days is ridiculously long. A bread or milk supplier would have to have that ratio at pretty much 1 day, because if you don't sell it within a day, then it goes in the rubbish bin. The final ratio that we're going to talk about here is the days creditors. Now again, it's still looking at a balance sheet figure and an income statement figure, but in this case the balance sheet figure is actually a current liability, your creditors or your accounts payable. And if you compare that to the cost of sales and multiply by 365, this gives you a measure of the number of days it's taking you to pay your creditors. How long does it take you between obtaining the goods or services from your supplier and paying for it? Now, this ratio has to be interpreted a little bit more carefully. Now, on the one hand, you can't pay them too slowly, These creditors may be a very important part of your business, they may be a very important part of a relationship, and you need them to look after you just like you need to look after them. However, purely from a cash flow point of view, and we don't care about the relationships issues, then paying them as slow as possible is certainly better for your cash flow. So therefore, again, it depends. There's a bit of a balance there between paying them without making them wait too long, given the damage you might do to that relationship, but at the same time, maybe not necessarily paying them as quickly as you possibly could pay them, because you like to keep the cash in your own pocket for as long as possible. It'll also depend upon the power of the relationship between you and the supplier. In some businesses where the supplier is very, very powerful, it may be such that you have to pay them quickly, otherwise they can damage you quite severely. On the other hand, if the customer is more important than the supplier, then in actual fact the customer might be able to say to the supplier, look, I'll pay you when I want to pay you, and you'll just have to live with that, because otherwise if I say no to you, then you'll suffer more than I will suffer if you stop supply.